Hello everyone, today in this video, we're gonna learn about how to do slip interpretation for performing CAT modeling and underwriting on any specific account or application. This will be an A to Z video, which will not only cover the important process, but also cover insights of the concepts, to understand the concepts once and forever. Let's start with it. Slip interpretation in catastrophic modeling involves analyzing and understanding the details provided in a slip, which is essentially a document that outlines the terms of insurance coverage, including the risks being insured, the premiums, and other key details. In the context of catastrophic modeling, a slip would detail the specifics of coverage for catastrophic events like earthquakes, hurricanes, or floods. For understanding how to do slip interpretation, it is vital to know why slip interpretation is important, how it impacts output, so starting from the start. Slip interpretation is important for detailed risk assessment, model calibration, and policy alignment. First is detailed risk assessment. Slip interpretation helps in accurately assessing the risk exposure and coverage provided. Catastrophic events often involve complex and high-value risks, so understanding the exact terms and limits is crucial. Second is model calibration. Accurate interpretation ensures that the catastrophic models are calibrated correctly. The models rely on the data from slips to simulate various scenarios and predict potential losses. Last but not the least, policy alignment, which means by interpreting slips correctly, insurers and reinsurers can align their policies with the actual coverage and limits specified, ensuring that they are adequately prepared for potential claims. To grasp slip interpretation thoroughly, it's essential to review key insurance basics, especially those related to the financial aspects of insurance. Insurance transfers the risk of financial losses from specific but unpredictable events from an individual or entity to an insurer in exchange for a premium. The insurer pools these premiums and the risk, spreading the financial impact of a disaster across a larger group. This mechanism, loss of the few, shared by many, involves setting premium. Let's understand some of the key terms that you will listen every now and then, while moving forward deep into the CAT modeling concepts. Exposure is a potential loss that hasn't yet happened. It is the measurement of how big the risk is. Example in property insurance, sum insured on the buildings and contents. Risk is the possibility of a financial loss. Perils is the direct cause of the loss. Example, earthquake, windstorm, tornado, flood, fire, terrorism. Hazard is condition or situation that creates or increases the chance of loss. Underwriting is the process by which the risk of the insured is assessed. Each individual or entity wishing to be insured brings a different level of risk to the insurer. For example, a timber house is at greater risk of fire than one made of brick. Rate making or insurance pricing is the process of determination of rates or premiums charged by insurance companies. Insurance companies are setting fair and adequate premiums to account for the losses as well as profit. Usually premium is divided into two parts. First is pure premium, also known as expected loss premium, loss cost, risk premium, basic premium, and second is gross premium, also known as fair premium, written premium, total or full premium, overall premium, charged premium. Pure premium refers to the actual premium paid by the insured that accounts for the possible losses faced by the insurer. Gross premium is equal to pure premium plus loading per exposure unit, which refers to the amount of the premium necessary to cover other administrative expenses, particularly sales expenses, to allow for a profit. Let's think about this example. This is something to understand how insurance pool works behind the curtains. 2,000 factories require a sum insured of $100 millions each. Statistically, we know that 2 factories get destroyed by fire every year. So, if the losses are to be paid for all the 2,000 factory owners, what should be the contribution by each factory owner by way of pure premium? Computer-aided assessment of losses arising from catastrophic events like earthquake, windstorm, flood, etc. The input into a typical CAT modeling software package is information on the exposures being analyzed that are vulnerable to catastrophe risk. The exposure data can be categorized into 3 basic groups. 1. Information of the site locations. 2. Information on the physical characteristics. 3. Information on the financial terms. which result into the accurate assessment of losses arising from catastrophic events. Let's deep dive into these three categories and understand what information comes under which header. First is information of the site locations, referred to as geocoding data like street address, postal code, latitude and longitude, county or crest zones, etc. Second is information on the physical characteristics of the exposures like construction class, occupancy, year built, number of stories, etc., and the consequential loss parameters like business interruption, i.e., disruption caused by damage to structure or location where a business operates, resulting in loss or reduction of income due to suspension of operation. Information on the financial terms of the insurance coverage like coverage value, limit, deductible, sublimit, etc. Don't skip to study, understand, and remember the financial terms like value and TIV. First is value, also known as full replacement cost of the risk, which is further divided into three broad categories, that is building, contents, and business interruption values. Let's understand the main difference among them. Building value is the value of the building structure itself and structure attached to building permanently. Contents value is the value of the non-building property at the location like computer, cash and furniture. Business interruption, BI, value is something that we discussed earlier as well when understanding information of physical characteristics. Yes, you are right, BI is the value of the business income that would be lost if the business were shut down for a 1-year period. Finally, TIV, which stands for total insured value. It is value that is covered by all insurance structures. It includes building, contents, and BI insured value. It is usually equal to the value of the risk. Moving ahead with other financial terms. First is limit. It is the maximum amount payable for each event by the insurer under the policy. Example for earthquake insurance with a total sum insured of $50 million. Then we have a subpart of limit which is known as sublimit. It is the maximum amount of loss that will be borne by the insurer for a specific region or peril. Sublimit is like a cap, depending on location, peril, and events in a given policy period. Second term is deductible, which is the amount of money that the policyholder must pay out of pocket before the insurance coverage kicks in. It's a fixed amount specified in the insurance policy. Another similar term is SIR, that is self-insured retention, which is the amount of money the policyholder must pay out of pocket before the insurer starts to pay for a claim. Unlike deductibles, SIRs often require the insured to handle claims management and costs up to the retention amount. Both of them are quite confusing. Let's understand this with the example. Under an SIR, the policy's limit is usually not affected by the SIR amount. Let's assume that your aggregate SIR under your general liability policy is $1 million and your total policy limits amount to $10 million. You would have $10 million of coverage excess of $1 million SIR. Under a deductible, the limit is usually eroded by the amount of the deductible. In the same scenario, in a deductible plan, your total limit of liability would also be $10 million. But $9 million of it would be available from the insurer, and you would be responsible for the initial $1 million. Understanding policy limit layer is essential for extracting the correct information during slip interpretation and implementing them accurately during risk analysis or risk modeling. This structure shows the different portion of a policy limit layer. Let's understand them one by one. Starting from ground-up loss, also known as GU, is the total financial loss regardless of the insurance structure that dictates who bears the loss, which does not consider any insurance structures like policies, deductibles, SIR, etc. Then we have gross loss, which is the section of loss to be paid by the insurer that is an insurance company. Client loss layer is the section of loss to be paid by the insured that is insurance policyholder or customer. Now it's time for understanding the term part of and attachment point, also known as excess of. First is part of, which is the amount of the entire policy layer, a vertical slice. Don't worry, we are going to see a visual representation of each limit layer to understand this properly. Let's move to attachment point before the visual representation. Attachment point or excess of is the amount, in addition to the deductible, at which policy begins to take loss. For example, slip says, no deductible and $2 million attachment point, which means the policy will begin to take loss once the risk has incurred $2 million of GU loss. Another example, if slip says $1 million deductible and $2 million attachment point, then it means policy will start after $3 million of GU loss. I know it is a little bit confusing. Let's make it clear now, by seeing how these layers look like when they are applied to any specific policy. We will also see 3 problem statements with their solutions and visual box diagram representation before finishing this video. This is how visual representation of limit layers looks like. It is also known as box diagram, so if your interviewer is asking a problem statement, try to make a box diagram to make them understand the solution. It will be easier for you to explain and easier for them to understand. Pause the video, take some time, have a look at it, and try to understand this. After this, we will directly jump on the problems one by one and try to solve them. Let's have a look at our very first and most simple example to understand how to make a box diagram for any problem statement. Pause this video and try to think the solution, because now onwards, the problem statement will going to be more complex. This problem says Megan has an insurance policy on a location valued at $500,000. She has a $5,000 deductible and is insured 100% to value. For this, draw a box diagram to answer the other questions accurately. Here are the solutions for the problem. First is the box diagram. This is how diagram will look like. For second question, the answer will be $0, since $3,000 is less than the deductible of $5,000, so Megan has to pay out of pocket and will receive nothing by insurer. For third question, the answer will be $445,000, reason is for a loss of $450,000, Megan pays the first $5,000 and receives the remaining $445,000 by insurer. Here we go with the second problem statement, which is Mike's yacht has a total insured value of $5 million. He has a 5% deductible and an insurance policy from Cindy Insurance, CI, that covers $3 million excess $1 million. Draw the box diagram and answer the following question, that is, how much does Mike receive from CI for a $1.1 million loss? And how much does he receive from CI if his yacht experiences a total loss? Pause the video and think about solution. The solution of the problem is on the screen now. Let's look at the answers of last 2 questions. Answer for first question is $0, since $1.1 million is below the CI policy attachment point. Mike receives $0 from Cindy Insurance. For second question, the answer will be $3 million. The reason is for a total loss, $5 million. Mike receives the policy limit of $3 million from CI. Let's understand the solution with box diagram. 5% deductible of $5 million, total insured value will be $250,000. Excess of $1 million means $1 million plus $250,000, that is $1.25 million. Which means if total loss will occur, the policy will only pay once it deduct $1.25 million from it. In this case, total loss will be equal to total insured value, that is $5 million. So as per calculation, $5 million minus $1.25 million will be $3.75 million, but in this statement, there is one more restriction, that is the policy limit is just $3 million. In this case, Mike can only get up to $3 million, no matter how much loss he will face. Now here is a new term, that is OLL, also known as over limit layer, which means anything over agreed limit. Remember the calculation, we were left with $3.75 million when we deducted $1.25 million from $5 million. So if you will deduct limit, which is $3 million from $3.75 million, you will get the over limit, which is $750,000, or in other words, anything remaining after complete exhaustion of agreed limit is known as OL or OLL or over limit layer. We would also like to show you how these results will look like in the RiskLink output. RiskLink is a catastrophic modeling software, which is used by most of the risk analysis or CAT modeling companies across the world. Try to pause the video and see the output and try to link it with the knowledge that you gained in initial phase of this video. Pause the video now. Last problem of this video, which will be the most tricky. Usually, during the technical round of the interview, interviewer will ask the same problem statement. Listen it carefully, pause or replay the video as much as you need to understand this. The problem is, Karen Insurance Incorporated, KII, has a 60% participation on a policy layer of $40 million excess $20 million. The risk covered by the policy is valued at $70 million. In this problem, we will discuss the application of part of clause and excess of clause. Like we did it for all the problem statements, we will draw a box diagram. And then we will answer the question, that is, how much does KII pay out for a $40 million loss? Let's look at the box diagram and understand all the portions, and color one by one. First layer, the gray one has name, UC means uncovered. As per the problem statement, it says $40 million excess $20 million, that is over $20 million of uncovered layer. There will be $40 million policy limit. Total value of the property is here $70 million. So, gray layer is $20 million. Second layer above $20 million till $40 million is the covered layer on a 60-40 basis. Now the green part tells 60% of $40 million will be covered by this insurance policy, and yellow part, that is OI, which stands for other insurance. So, other insurance company will cover 40% of $40 million of covered layer. And anything above that will be known as over limit layer that we discussed in previous problem. Answer for this problem will be $12 million. Without wasting time, let's calculate it. For a loss of $40 million, KII pays out the $12 million, which is 60% of $40 million of loss minus $20 million of uncovered layer. Pause the video and calculate with your own. This is how the output result will look like in the RiskLink output. Insurer gross layer will tell us the amount of money to be paid for the asked problem statement. Pause the video and look at the results. Pause it now. After this, I will give you 10 case study. Try to solve it and answer in the comment how much will be ground up loss, gross loss, and client loss.